A warm welcome to you. We are now planning to study the second lesson under the subject Financial Clients Management, which is Clients Confidence Management. Under this lesson, we will be concentrating on topics such as the importance of gaining the confidence and trust of customers in order to maintain financial stability in financial institutions, the sovereign right of customers to choose amongst different financial products in a competitive market, developing and maintaining a good relationship with the customers, customer-specific products and open or common products, innovative or complex products and their risks, transparency of product specifications and their risks, entering into agreements and documentation. Stability of the financial system depends on the stability of the monetary system, the financial market, and the structure of the financial institution. Let us now look at the definition of these three areas. The monetary system enables the transfer of money between the borrower and the lender. In general, a monetary system is the set of institutions by which a government provides money in a country's economy. The financial market is where individuals and companies engage in the trading of commodities as well as corporate bonds and so on and so forth. The structure of the financial institution determines the method of dealing with commodities, corporate bonds, and so on and so forth. If a company has sufficient assets to settle all its liabilities without increasing their total liabilities any further, such a company can be considered as a financially stable company. All the economic resources held by a company are classified as assets. However, different types of assets are created based on the type of business the company is engaged in. Hence, we can consider all the future anticipated economic resources that the company owns and controls as the assets of that company. What you see on the screen now are the characteristics of the assets held by a business. A company would have different types of assets. They can be segregated into two types based on the activities of the business. Current assets are the assets that fluctuate on a daily basis due to the business activities of the company. These assets are usually held for less than 12 months. The stock in trade and the trade debtors are examples for the same. The assets that are not affected by the day-to-day business activities of the company and are usually held for over 12 months are classified as fixed assets. Apart from the capital contribution made by the owners of a business, the other funds used to run the business are called liabilities. A part of the profits earned by the business have to be diverted to pay as interest on the liabilities or loans obtained by the company to invest in its assets. The characteristics of the liabilities held in a business are now displayed on the screen. The liabilities of a business can be segregated into two types based on the time taken to settle the liabilities. They are the current liabilities and non-current liabilities. They are also called long-term liabilities. The liabilities of a business that has to be settled within 12 months are classified as current liabilities. The creditors of the business can be taken as an example for the same. The liabilities that cannot be settled within 12 months are classified as non-current liabilities. Usually, when a company obtains a non-current liability, they would have to place a security against same. Long-term bank loans are an example for non-current liabilities. Let us now look at the ways of gaining financial stability. You can minimize financial irregularities and create financial stability by carefully segregating the personal and corporate financial transactions. You should ideally be qualified in multiple fields, both professionally and academically, in order to create a good market for your business. To set personal financial goals in order to achieve the profit targets. Further, you could have constant dialogues and interaction with professionals in order to minimize and correct the mistakes of the business. Let us now look at the options available to create a stable financial system. In order to get further details, click on each option. Customer confidence is extremely important in order to attract deposits towards the company. When the customer confidence is created, the employees can easily canvass deposits from the market. When the customer confidence is high towards a bank or a finance company, the customers prefer to keep the deposits in the same company. Companies that have built a good customer confidence towards them will have a large deposit base to lend to the borrowers. Further, such companies would thoroughly scrutinize their borrowers to see if they are creditworthy before lending to them. When the savings base increases, the loan base will also increase, resulting in the company recording a higher profit. Let us now discuss about profits. We can describe profits as follows. The profit belongs to the owner, hence the profits add up to the net worth of the owner. We can either calculate the profit and add it to the net worth, or add the income to the net worth and then deduct the expenses. In other words, the income will increase the net worth whilst expenses will eat into the net worth. As discussed earlier, the profit of a business is received by the owners of that company. These profits will result in the increase of the net worth of the company. Apart from the profits, another way of increasing the net worth of the company is by infusing fresh capital by the owners. However, net worth increases of this nature are not considered as an increase of the income. Accordingly, apart from fresh capital infusions made by the owners, all other modes that result in the increase in net worth of a company are considered as income. Since all the income of a company is enjoyed by the owners, the expenses of a company should also be borne by the owners. Hence, the expenses should be deducted from the income. However, reductions to the net worth are not only affected by the expenses. Cash withdrawals and the use of company assets by the owners will also result in a reduction of the net worth. The difference between the income and expenses discussed earlier in the lesson is called either the profit or the loss. Whether it is a profit or a loss, it is for the account of the owners. Hence, the profit or the loss is finally accounted with the net worth. At this point, what is left are the assets, liabilities, and the net worth. The accounting formula for these is displayed on the screen now. A competitive market is one in which a large number of producers compete with each other to increase their profits by satisfying the wants and needs of a large number of consumers. In a competitive market, no single producer or group of producers and no single consumer or group of consumers can dictate how the market operates. The customer is the king in a competitive market since, without winning the hearts of the customers, a business will not be able to sell their goods and services. In a competitive market, the customers are the deciding factor in determining the profitability of a company. The customers compare different optional products available in the market before purchasing a product. Hence, companies that compete in the market produce and market products of high quality and better customer attraction. Let us now look at how a good customer relationship can be developed. Since it takes a long time to build a good customer relationship, it is important to have patience when dealing with new customers. A good understanding about different service providers and businesses is important to build a good business relationship. Further, if you treat all your customers as if he or she is your best customer, it will be easy to develop a good customer relationship. Responding to customer requirements promptly will enable the company to build a good customer relationship. Further, when providing a service, it is important that you educate the customer on the complete process of the transaction. A product is an object or a service that can fulfill the needs of a person. Products that are directly sold to the customers are called over-the-counter products. In the financial industry, a check is considered an over-the-counter product. Given here are some of the risks that can be identified when a teller encashes a check over the counter. Common products in the financial industry can be used by any bank or financial institution. However, they do not own such products. The risk in such a product is that these may take a long time to rectify if an error has taken place. In some instances, the bank may even not be able to rectify the error. Innovative products are the products that were not in the market up to now, which could be used for specialized requirements. The product not being attractive to the consumer, the product not being up to the expectations of the customer, and the introduction of substitute products can be considered as instances where companies may face risks in marketing innovative products. The information pertaining to product specifications will include information pertaining to the manufacturing process, the ingredients or components used, and the benefits to the consumer. The product specifications should be made available to the customer in a transparent and clear way. This will result in an increase in the confidence level of the consumer. Further, the information pertaining to side effects of using the product should be clearly communicated to the consumer. It is very important to educate the customer prior to entering into agreements with the customers. Further, it should be done in an orderly and transparent manner. These agreements should be stored in a secure place. We have now come to the end of the second lesson, Managing the Confidence of Clients, falling under our main subject, Financial Client Management. You may try to answer the questions appearing on the screen and revise the content that you learned under this lesson. We wish you a happy learning experience until we see you again with another interesting lesson.